Still people arriving, so we'll give it another 30 seconds or so. Lost David. Where's he gone?
Me, you mean?
Yeah. Oh, you are there.
I'm here.
Yep. I'm seeing 3 pages of people now, and there's people still coming in. There's more they're coming in, so we'll wait another. Right, it seems to have slowed down a bit now. Okay. Shall we start? I think so. Good. Okay. Well, hopefully everybody can hear me clearly. First thing to do is to welcome you to the webinar, the PH Report 10th anniversary webinar. And I must mention it's being recorded, so please be aware it's been recorded. And you will notice that everybody's cameras and microphones are off, and that is a default of the webinar setup. So to kick off, the team will share their thoughts on what the future holds, and then we'll run through any questions that people have got to ask. You'll hear from Paul Hodges, from David Hughes, Paul Satchell, and Daniel de Blocq from Scheltinga. I'm not sure the order of the speakers, but I think you'll hear from them all. And the presentations should take about 20 minutes. After that, we'll start running through questions. If you've got a question, please use the Q&A facility, which you'll see at the top of the screen. And as important, if you like someone else's question, give it the thumbs up. And then what we'll try and do is focus on those that have got the most clicks, most likes. So without further ado, I will hand over to Paul Hodges, Chairman of New Normal and Editor of the PH Report, who will kick the webinar off. Over to you, Paul.
Great. Well, thank you very much, Dave, and thanks to everyone for joining us today. We're really excited, as you can imagine, that we started this report 10 years ago, and it is quite a different report from sort of conventional reports in that we talk about a number of core themes, and we look at those themes from a variety of aspects in order to try and give a more in-depth discussion than one can do by just a couple of paragraphs. And so where we are today, what's our theme that we're talking through? Essentially, we've seen the end of central bank stimulus, the very low rate, the zero rate policies that we saw for the last 10 or 15 years. And what's happening now is that we're seeing markets rediscover their core role of price discovery. This was denied by the central bank because they were always giving more stimulus, they were always keeping interest rates low, so markets didn't really have much of a chance. But markets are now coming back. And what I want to do, if you can move on to the first slide, Dave, is just to talk through one of our core issues, which is demographics. Because we've argued really for quite a long time now, since we published our book on the subject, Boom, Gloom, and the New Normal, how the Western baby boomers are changing demand patterns again. That was in 2011, that demand is key. It's people that create demand. It's not central banks or anything else. And the core change that has happened in our lifetimes is that we first of all had the baby boomers, and they are now, thanks to greater life expectancy, living beyond the age that they would have expected to back in 1950, and they've now become the perennials 55 generation. And remarkably, this generation, the perennials, are the largest main source of population growth globally and in the top 10 economies. You can see on the first chart there the change, but you go back to 1950, everywhere more or less, the proportion of people over the age of 55 was less than 20%. Today, Only India is in that position. And if you look at countries like Japan and Italy, they are up close to 50%. And so you can see on the left-hand side there, the charts, the oldest boomer born in 1946, became a perennial in 2001, a long time ago. And next year, the youngest boomer, born in 1950, will become a perennial. You look at them then by comparison with the high income group, which is 16% of the population, nearly 2/3 of global GDP. You look at the middle income group, which is a third of GDP and 75% of the population, exactly the same trends. We can move to the next slide, Dave. And you say, well, okay, that's very interesting, Paul, but does it really matter to me from an investment or a company point of view? And the answer is yes, it really does, because the perennials are essentially a replacement market. They already own most of what their needs. And you can see we've taken three important economies here, the US, the UK, excuse me, and Japan. And you can see how spending really drops away after the age of 50 to 55. So under the age of 25, you're at college, you're doing your apprenticeship, you're mainly living on your parents' money or what little you earn from weekend or evening jobs and so on. But after 25, your income starts to move up. You move in your career. You may well settle down. You may well take a partner. You may well buy a house, buy a car, and so on. You may well have children. Children, then obviously demand continues to grow because they continue to grow. And it peaks at that age of around 55. And then 20 years later, it's fallen 40% or so. So you're really seeing a major shift here, that these are the largest growth group of growth in the world population, and they are a replacement society. So yes, they own something. If it goes wrong, gets old, they replace it, but they're not buying new stuff as they were when they were having children. So, Dave, we can have the next slide. Well, if we look at the economic outlook, which is one of the things that we do every report, and we're going to take you through the various areas that we cover in the report each month. What we can see if we look at the economic outlook is a nice comment from the Wall Street Journal earlier this month, which is exactly what we would have said. The Fed's it says it's data dependent. Well, that means it's driving through the rear view mirror. You only know about data when it's happened. They're not telling us where it's going. And so what you can see, however, is that the 40-year decline in Treasury yields for the 10-year Treasury have started to increase. And what we've also seen recently is that the earnings yield on stocks, on equities in the States, which is the largest single market, it's now reversed back to a more normal position. So that, and remarkably, what we saw was that after the Fed's last meeting, they cut interest rates by 0.5%, the rates they control, the short-term Fed funds. But if you look at the actual market rates for the 10-year, it's increased by 0.5%. So mortgage rates in the States have gone up, auto loan rates so on have gone up. In other words, the market is really now taking back control from the central banks. This is probably going to be quite a bumpy ride because it's been quite a long time since the market was in control. And I have the next slide before I hand on to Paul. The area that we're really focusing on at the moment is what's happening in Asia. And one of the things we try and do in the report is we do try to be forward looking. And we've been talking now about Asian currency weakness for over a year. And you may have seen there's been some initial signs of turbulence in Japan, that the yen fell to 160 versus the dollar a month or two ago. The Bank of Japan panicked. It started to put up interest rates and so on. The yen got stronger again. But now the whole the exercise is repeating itself, and the yen is weakening again. And the problem, as you can see, for the yen, for the Chinese renminbi, for the Indian rupee, and the Korean won, those four big currencies, they are all export dependent, and exports are drying up because of the slowdown in the Western economies that we all know about. And so these economies are really in the eye of the storm. And we anticipate some major fluctuations because particularly Japan and China, have very, very high levels of debt to GDP, over 300% in the case of China, over 250% in the case of Japan. And if you've got an aging population, you don't get a lot of growth. So that growth is not going to take out the debt. The debt is going to stay there and potentially become worse. Over to you, Paul.
Thanks, Paul. Next slide, please, Dave. Well, here we see the profile of debt over the last decade or so. We think this is one of the biggest structural impediments to growth that the world has. It's understandable that post-COVID there had been a leap in debt, but it was expected that would decline as a percent of GDP over time. But as you can see, it's now leveled out into in excess of 330% of global GDP. The issue is, for decades now, there's been a tacit assumption that the debt would wither on the vine through inflation. Now, given the risk of deflation, which we see, that threatens exactly the opposite, and that debt becomes ever less manageable. Now, debt levels inhibit growth, both at a solvency and liquidity level. Debt service costs affect liquidity, confidence affects solvency. And that adds to the demographic deficit that Paul's talked about. One of the structural issues at the moment, that we've had a tremendous number of elections during this year. And there's a great big shopping list amongst candidates still to stand. And in the case of the UK, a government that's just come into place, with a shopping list which largely will have to be debt funded. And certainly, should Donald Trump win the election, there are predictions of astronomical increases in US government debt, for example. So we see this as one of the problems which is going to inhibit the growth which we require to grow out of the remainder of the problems in the world. Looking at markets, Dave, could you go on to the next slide, please? We don't. I won't talk you through the detail of each individual slide. That's available in the slide pack, which I think you'll have, and it'll certainly is in the report, which will be sent tomorrow, I believe. We see that the key issue here is to separate out the short term and the long term. And in the short term, there certainly will be a great deal of volatility, we believe, expecting the unexpected at both operational levels for individual companies, but also a great deal of volatility in markets. However, at some time, we will move into a new equilibrium. And what we expect to see is a newly polar world. And there will become threats and opportunities from this. And those slides, the right-hand table, goes through some of the overarching themes by asset class, and I'll just highlight a couple of them. We think for large cap equities, the global realignment, which we expect to see, will make significant changes in supply chains, but companies that are have robust cash flow and the right kind of geographical exposure, we think will be able to take advantage of them. We think in the sovereign debt area, the strong will become stronger, and the safe haven for everybody is likely to then be US Treasuries. And I think commodities are a particularly interesting area, because in a multipolar world where you expect to have seen trade wars over the next coming couple of years, we think commodity prices could become a lot more localized. If there are trade barriers between various portions of the world, commodity markets become much more local or regional at best. So you have a risk of assets becoming stranded where they're not allowed to be transported between various parts of the world. I won't take you through any more detail on that. As I say, there's a lot of it in the report and on the slides, but we think the world is likely to look a very different place in 3 to 5 years from now than it stands at this moment. And with that, I'd pass you on to David.
Thanks, Paul. I'm David Hughes. I tend to write the energy section of the report, and as Paul says, we think the world will look very different in many ways, and one of the places that the world will look very different is in the energy world. Today, the energy world is balanced between two very great forces. On the one hand, of course, we have conflict in the Middle East, we have conflict in Russia, both major supply areas, and we have growing conflict around the Far East with Korea these days, and of course Taiwan, part of the big consumption part of the world. So the risks around oil supply and in fact gas supply are extremely large. The Straits of Hormuz remains a choke point through which 20% of the world's energy passes every day and would potentially be very easily blocked. But on the other hand, demand is showing great signs of weakness. Not only is the flat price of oil only at $70 with these threats around us, but also refining margins are under pressure. Very bizarrely, the world is still building oil refineries just as demand starts to peak, and oil refiners are starting to suffer across the world, and we're seeing closures in Europe and in other parts of the world already starting to happen. And of course, one of the root causes of this is the electrification of transport. We are very bullish on the future of electric vehicles. We believe that the cost curves are driving down the cost of electric vehicles to the point where they will essentially very rapidly replace the incumbent ICE. That's happening in the passenger car market, but equally importantly, in the heavy trucking market, batteries are starting to take over. And in fact, in China, as we cover in the report, LNG, liquefied natural gas, is now taking up to 50% of new truck sales and really denting demand there. So Chinese demand looking weak because of electrification. Europe and the US have not recovered from the pandemic, and gasoline demand is lower today than it was before the pandemic. And we think that is an inevitable route forward. So OPEC has a dilemma. OPEC has cut 5 million barrels of production, but the IEA says that oil demand will peak around 3 million barrels a day higher than today's demand. So there is very little space for OPEC to reverse their cuts, and how OPEC react after the US election will be very telling for the short-term future of the energy markets. Happy to talk more about that in the questions. But I'll pass on to Daniel, and Daniel will talk about China, one of the other major areas that we cover in the report.
Thank you very much. Thank you for this opportunity. The last 10 years of PH Report, I think, have been timed impeccably, because they've been the years where we've seen, I think, the most monumental changes in China, that much more than we could have ever imagined, due primarily to one reason, that's President of China Xi Jinping. He became president in March 2013. The fact that one individual can remain president for more than 10 years in China is already indicative of one major and fundamental change in the leadership structure. The consensus, the so-called consensus system, in which the highest executive organ, the Standing Committee of the Politburo, was composed of different factional stands and members were equals, that's been abolished. And the new system is one in which the president is primus inter pares, first among equals. Indications are that President Xi intends to stay president until after 2029, which is the 80th anniversary of the founding of the PRC. Why? Why would this be so? Because he wants to be remembered as the president who succeeded in accomplishing the great Chinese rejuvenation. Wei Da Fu Jing, or in contemporary American language, I suppose you could call it, make China great again. What is that exactly? It's a combination of a nostalgia for China's past and its 5,000-year history, combined with a vision of a future in which China is green, respected, strong, and above all, equal in influence and respect to the United States or anyone else for that matter. This strong China will have a center stage in international affairs. That dream most likely also includes some sort of solution to the Taiwan issue. This dream is important and quite popular also amongst people, because it was also helped in fostered not only by the Chinese media and amplified during the 2008-2009 financial crisis, which was presented as proof that the Western financial system, doesn't work. It's a failed system where even private financial institutions suddenly had to become public institutions, just like the Chinese institutions. So what does this all mean? We've spoken and we've written, many, many times in our reports about the fundamental issues that China still has: the real estate crisis, the local government debt issues, and the lack of sort of domestic demand following COVID. Why is this Xi Jinping one-man show so important? It means that when government decisions are finally taken and stuck with, they are continued, even if there are strong indications they're not working, until it becomes absolutely urgent, last minute, to change course. We saw this with the COVID U-turn, and most recently we saw it again with the economic stimulus U-turn. So, to predict what's going to happen in China in the coming years, Xi Jinping will continue to fight for the great Chinese rejuvenation. That includes China trying to become the leader of the so-called global South, which is increasingly a term that's used in the Chinese press and government communiques. And how that will all pan out, we'll see, but it will certainly be remain a bumpy ride. That's for sure. That's my 2 minutes. Who's after me?
So thank you, thank you, Daniel. We also cover a range of important topics in the report, such as sustainability, and they're interesting in their own right, obviously, because sustainability is a very important area as we move forward on net zero and other challenges, climate change, etc. But they're also typical and symptomize the changes taking place in demand patterns, partly because of this rise of the perennials that we talked about earlier. So if we take the apparel markets, for example, which we're writing about in this month's report, what we can see is that the apparel markets, which grew like mad over the last 40 or 50 years because world population grew so dramatically, that is now also starting to slow down that growth, and it's plateauing because as you get older, you already have a lot of the clothes that you want, and you haven't got a lot of young people who want to go out to a party and then throw that dress or suit away and buy another one. So we've got big change taking place in the fiber market itself. We've got also geopolitics coming into this. So China's treatment of the Uyghurs, for example, has sparked quite a backlash about buying Chinese cotton in the US. And you can see there from the US Fiber Association that their surveys show that US cotton textile buyers are moving away from China over the next couple of years to India, to Brazil, and also domestically. So there's quite a series of shifts taking place in these markets. At the same time, the other main textile, polyester, grateful to Reliance for this this slide. What we're seeing there, polyester fiber value delta margins are at all-time lows. In other words, you've got a lot of overcapacity in cotton, you've got a lot of overcapacity in polyester, and importantly, you have this new trend of vintage fashion, as you can see from the photo there from the London Fashion Show. It's the first time ever, I think, that a recognised fashion show has shown second-hand clothing. but this is now seen to be quite a big area, and even companies like Alibaba are expecting it to grow to tens of billions of dollars of trade. Dave, we can have. We couldn't do a webinar this close to the US election and not talk about the election. We actually have quite a good record in talking about elections. If you were with us 2015, 2016, we were suggesting for 15 months that actually it was quite possible for Donald Trump to win. And even 2 weeks before the election, the New York Times came out with a headline saying that Hillary Clinton had a 91% chance of winning. And we were still saying, no, actually, we think the populism market will support Trump. And of course, he did, with great confusion for everybody who hadn't done the scenario planning that they should have done based on what would happen if Trump did win. When we came to 2020, it was reasonably easy, I think, to see that Joe Biden would win. But also what I think was more difficult was our forecast, and we headlined it, was that we thought Trump would refuse to accept the result. And this has proved, to be, far more long-lasting than we ever expected. We didn't expect an invasion of the Capitol. I don't want to pretend anything like that. There's horrific things like that. But that underlying trend is really important for companies, really important for investors. Populism and then refusing to accept the result. And where are we today? And so we can't duck out of saying where we are today. At the end of the day, a lot of people have made up their minds already. What do we think is going to be the deciding factor? If you look at Real Clear Politics, for example, there's 104 electoral college votes which are in the toss-up area, as you can see there in the chart. And it seems, from our discussions, that this is going to come down to two things. Kamala Harris is focusing on the abortion issue, the repeal of Roe versus Wade, and a woman's right to control her body, whereas Donald Trump is focusing on immigration and control of the border. Which one will win, we think, is going to define the result, and we actually think that the woman's right to choose and control her body is going to be the more powerful one. That's our view. We will see in a couple of weeks' time, but it's probably going to be quite a difficult result period. Dave, final slide. So we're coming in just on time, which is good news. One of the things we always talk about in the report, and really is the background to our success over the last 10 years, is that we are all experts in chemicals, and we're working in various parts of the world, in various parts of the business, and so on. And chemicals is a very early stage business in the value chain. So we typically will see what's happening 6 to 9 months, sometimes even 12 months ahead of the rest of the world. By the time it gets down, Peter Lynch, the great investor in the States for the Magellan Fund in the 80s, used to say, people who are out in the real world see things happening a long time before the news gets to Wall Street. And that really is the benefit and the value proposition for the chemicals industry. And what we're seeing is that demand is fading in the Western world because of the perennials, because of the cost of living crisis, and so on. We also see China has failed to make its transition through the middle income gap, and it needs to increase consumption. Its domestic consumption levels are only about half that of the States in terms of GDP, about 37% of GDP compared to 70% in the States. And so China is, as we saw in Daniel's slide, China is exporting deflation now, and has been. Its producer prices have been negative for 2 years. And so this is pushing out, irrespective of what's happening in the Middle East and concerns like that and so on, this is pushing out deflation. So we see, if we look forward, potentially a major deflationary downturn. We see winners and losers emerging as some companies react earlier and more effectively. And we also see, and this is probably most important, the growth of the perennials, the rise of the net zero agenda creates an opportunity for reinvention and a growth opportunity. So, which would be more service and sustainability based rather than product based. So I would like you to go away with the sense that, yes, we are fairly realistic about what's going on at the moment. We're not over optimistic, but we are also looking forward, and we're looking forward very positively based on opportunities that we, from what we see, there are big opportunities ahead for investors and companies, and we hope that our advice will help you to succeed. So, Dave, back to you. Thank you very much. You're on mute, Dave.
The classic Teams issue. You're on mute. Right. Okay. Thanks very much, everyone. There are a few follow-up questions which I already have here, and I'm not going to sort of in a particular order, but picking up the first one, question for David Hughes. Picking up and elaborating a bit on the impact of electric vehicles. Are they really happening? There's been news of the slowdown in the adoption, apart from Norway. And what about autonomous vehicles as well?
Okay, big issues, I think. That slowdown, of course, is not a global slowdown. On a global basis, EV sales are accelerating. I think that what's happened is that the car industry has been suckered into the idea, at least the Western car industry has been suckered into the idea that people want to buy cars at the $50,000 to $70,000 price point. There was a time at the end of the pandemic, we all had a bit more money in our pockets. Interest rates were still zero. We were keen to spend that money that we hadn't been able to spend through the pandemic. And people went out and bought cars, expensive cars. The average price of cars in the US went up to $50,000, which is just unbelievable, right? But I think that time is over, and people want to buy an affordable car, I don't know, somewhere around the $25,000 mark. And the Western companies have not found themselves able to produce an EV at that price point. But Chinese companies clearly have. Chinese companies can produce a $10,000 EV very nicely, thank you very much. And at that point, if those were available to Western buyers at that price point and not protected by 100% tariffs as we've got in the US, then they would simply fly off the forecourt because they're a better car at a cheaper price point. So we believe that either, China exports to the world at that price point. Tariffs will try and protect the dying or the vulnerable industries in the US and Europe, but might be difficult to do that. And at the point when the sticker price of a car with 300 miles of range is less than the sticker price of a IC of the same sort of range, then nobody's going to pay for the more expensive car, right? They'll buy the EV because it's cheaper. So we're very bullish because the cost of EVs is fundamentally coming down as production rises and as battery costs fall. AVs, very significant. The chemical industry depends upon the automotive industry. A huge amount of chemicals goes into that automotive industry. So the future of the automotive industry is a critical success factor for the chemical industry. But AVs exist, right? They are running around the streets of San Francisco. They're driving, roughly speaking, 1 million miles a week in the US. So they're learning, very rapidly. They're running around the streets of China. And once those become widely available, and we can't be more than a handful of years away from the point at which they become widely available, we believe that the vast majority of urban dwellers will not buy a car. They would far rather use an autonomous Uber. And we'll see private car ownership drop dramatically. And because the utilization rate of an Uber is far higher than the utilization of a private car, which is only about 4%, right? 96% of the time your car sits and rusts, then the world obviously needs massively fewer cars, which is great news for everybody, except perhaps those companies which are dependent upon selling into the automotive industry. So yeah, very bullish on AVs. I tend to say the next car you buy will be an EV, if you haven't already bought one, and that will be the last car you ever buy, because by the time you come to replace that car, you won't, because you'll just get a private an Uber, an AV Uber. I'll finish there. I could talk all day on that topic.
Thanks, David. Got a question here. I'm not sure what this is referring to, but let's see whether we can work this out. So is this a paradigm shift? This could be the whole thing. And how do you think the new demand structures would look like, particularly in a divided protectionism-led world? I'm not sure. Do you get that one, Paul? Yeah.
Okay, I'll start to pick that. It's a very interesting and complex question that one needs more time than a couple of minutes probably, but we can go into that afterwards if people would like. I think what you've got is governments reacting to important industries and employment in important industries. If you go back 20 or 30 years, governments in the West weren't terribly bothered about low-paying textile jobs, for example, moving out to China and to Asia. That was fine. We didn't particularly need those jobs. We had good employment levels, and consumers obviously liked having much cheaper clothes. So that was a benefit. Are governments that happy about having a car industry, their most important industry, with their most important, as the most important manufacturing industry in the world, very important supply chains and very high paying jobs as well? Are they happy with that being offshored? Well, the answer is certainly not. And I think China's made a big mistake in thinking that just because you come out with a better mousetrap, as it were, a better electric vehicle, they've done all that right. They've got much better cars. I saw Jim Farley, the CEO of Ford, says he's been driving a Xiaomi EV for the last few months and thinks it's superb. So there is a car company saying that it's superb, but very difficult to sell if you're going to take away Western jobs in a core industry. So that leads you into protectionism. We were also talking earlier, Paul was talking about how we move to more local for local manufacturing. So we don't, from a sustainability point of view, of course, it's not terribly good news to be moving stuff thousands of miles, thousands of kilometers around. So there's various ways where I think what we're going to see is a re-establishment and a reinvention of the auto industry, either by Western companies who move very fast, usually in conjunction with Chinese companies. Leap Motor, for example, and Stellantis got a very big partnership coming in, or we will see Chinese companies themselves onshoring into Europe, and if they can't go into the States, into Mexico and maybe Canada.
Okay, thank you. Another question here. I think this one's for David Hughes. What are your views on bio-based versus your comment about increases in refinery capacity?
So I think the issue here is that the conventional core of the chemical complex is the cracker, and there are kind of two flavors of those. There are gas-based ethane crackers, and they are probably okay, right? Because if ethane comes out of the ground, and it will for some time as natural gas continues to be used, then it has to go somewhere, and the ethane cracker is a good place to put it. But the naphtha cracker is under threat from multiple angles. It's under threat as refineries close, then naphtha will not become available, except perhaps temporarily. But in the long run, as refineries close, naphtha will also become unavailable. It's under threat from its CO2 footprint. Naphtha crackers are extremely heavy CO2 footprint. And of course, it's under threat from limited demand growth. We're not calling peak petrochemical, peak polymer demand here, but we do think that demand growth from this point on is very slow, and as we increase the amount of recycling and so on, then the naphtha cracker is under threat. So the question then is, what fills the gap? One of the areas we're very interested in is ethanol. There's a lot of ethanol grown in the world today, particularly in the US and in Europe, ethanol which is destined for the fuels market, which ends up as bio ethanol going into gasoline. As gasoline demand drops, that material becomes available, and it's not affected by land use concerns or whatever, because it's already been grown. Politicians love farmers, and they'll probably want to protect the farmers and let the farmers continue to grow the crops for the ethanol. So we obviously have routes from ethanol to ethylene. Braskem is doing that successfully in Brazil. Not terrifically difficult chemistry. So we are bullish that. We're bullish some of the other routes from waste to chemicals, but it is a difficult question. The chemical industry fundamentally needs carbon atoms. Bio will certainly play a piece of that. Whether it can get much beyond, let's say, 25% of the demand of the chemical industry is perhaps difficult to see.
Okay, thank you. This next question is definitely a demographics one, maybe for Paul again. So what products and services do you think will benefit from the ageing society in Western countries? Any thoughts about consumers' appetite for more nutritious, healthy food? Anything we should look for?
Yeah, I mean, I think what we're going to do is we're going to reimagine or reinvent core needs. So, for example, today, as David was saying, we talk about owning a car, but why do we own a car? For reasons of mobility. If there was a self-driving car available, and if it's run by Uber, who already have all the details of traffic patterns and so on, so they know that I need to go to X at 12 o'clock and I need to go Y and so on, and there's going to be a car there, it's reliable, and if I'm going to the airport, it will be there, I won't miss the plane and so on, then that will take over a significant part of the car driving. But there's still that demand for mobility, and so Uber and self-driving cars is a good example of how reimagine the debate, moving from cars to self-driving cars, just as we moved from horse-drawn to petrol-driven cars 120 years ago. If we look at shelter, for example, if you do move to self-driving cars, most cities have about 25 or 30% of their land dedicated to cars for parking, dead ground. What we're already seeing in countries like the Netherlands and Scandinavia is that a lot of that land is now being taken back and being used for recreation. So does this create an opportunity? I suspect it does, for more people to live in a more leisurely way in cities, not crowded together, if you like. And does that change the way that you will bring up children? Importantly also, does that going to change the way that older people live? Is it easier? I suspect it is, for older people to come back into cities rather than living in suburbs, because they've got better access to hospitals, they've got better access to shops and so on. And if you can make it easy for them to do that, then that would change the housing market. So, there are a lot of opportunities here. Sustainability, we were talking about clothing and so on, reuse, vintage clothing and so on. All of these things are changing together. It's difficult to say exactly how it works through, but it's certainly worth spending some time thinking through, well, in my industry or in my investments, how could this change? And then you've got some options, so you can see how the market is going. Were you right to think that would happen? Oh no, I wasn't. It was going that way instead. That's as valuable as getting it right first time.
Thanks, Paul. We've got a question here, which, and we've got more than one question now getting likes. This one I think is for Daniel. Can you expand on your view on the potential for consumption in China to increase as a percentage of GDP, given how low it is versus, for example, the US, UK? Or will demographics, middle income track, and other headwinds prevent this?
That's an easy question. Thank you.
It's from Ian Anderson.
Oh, okay. Thanks a lot, Ian. Look, obviously the government, this recent U-turn, but other noises you hear, and some of the things that are being published from Chinese think tanks and economists, they realize they have a major problem. Domestic consumption has been historically low in China because of the lack of a safety net. The hospital bills that people need to pay that are not privileged, the schools they want to send their children to, if they want them to succeed, to be able to enter the top universities, all of that is expensive. There is public schooling, but if you want to succeed and be able to send your child to Beijing University, you have to come from one of the best schools. They compete intensely in a way that you can't imagine in the West, even for kindergarten places, because those are the best kindergartens that send their children to the best elementary schools. That's one of the things that the government tried to crack down on when they cracked down on the exorbitant fees that tutoring and that online tutors were asking. But it hasn't solved the problem. The fundamental problem is this it's not only a Chinese, it's a fundamental Asian philosophy about saving more and borrowing less. But then in the Chinese context, that is amplified because of a lack of trust in the social security net. And COVID didn't help either, because it just showed, hey, help, the government can do crazy things. We can be stuck in our house. We can't have any access to things we need. We need to be more careful. There was a small post-COVID bump in consumption, but it certainly didn't last very long because people are very careful. So how will this change? This has to change with a number of things. One is the ability for people to be workers to be more mobile and to be able to register in other cities. That whole haiku system, that the government has said in the last third plenum announcement, they said they would take a look at. They would change it. We haven't seen that yet, but generally when they say something, it does happen. So it's a question of time. That will help. Because once they are registered in a city, they do have access to some of the social security benefits. All the migrant workers that come from the countryside and move, all of that's getting less and less. But in the cities, until now they never had access to any of the social security benefits or rights in that city because they were not officially registered. So once that changes, that will help a sense of security on that level. But if you look at the middle class, they're still not spending as they should. I don't see that changing very quickly, to be honest. I think a lot more needs to happen. Part of it is related, of course, to the real estate crisis, which has now gone on for quite a long time. I mean, everything is interrelated in China. Once that is solved, and that will be solved, I think, by, at the end of the day, special vehicles that the government will have to take over, unsold properties and save some of the real estate companies, special purpose vehicles, and ensure that the people do get apartments that they pay for, and ensure that the people don't need to put deposits for apartments, 3 years in advance before they've even started construction. But do I see strong growth in domestic demand, in the very near future? No, not really. It's too complex. it's too interrelated. It will take some time. I mean, I could speak for an hour on this subject alone, but I hope this
we
helps.
don't have an hour, unfortunately.
I hope it helps a little bit.
Thank you, Daniel. I'm not sure who wants to take this one. So how do you see changes in weather impacting global markets and supply chains over the coming years? I think we're talking about the fundamental changes in the weather, not short-term weather changes.
Why not Paul?
Generally unhelpful. Sorry, I'm not referring to me getting the question, but generally unhelpful. I think is probably, it's bound to be disruptive on a short-term view. Unpredictability in delivery becomes a factor, both from the point of view of transportation, but also crop. Most agricultural crops, for example, are crucially dependent on weather, and whether the weather's getting warmer or drier or wetter or less predictable where it comes from, it's extremely likely to be, for example, champagne. Now, large swathes of the southeast of the UK are being brought up by champagne houses simply because of the weather, and the soil is now better suited to making champagne than it is in Champagne, where it's now becoming too hot for large portions of the year. That's a happy story if you happen to own large swathes of the southeast, there's chalk underneath it, but it'll become a much more serious story in parts, particularly the southern hemisphere. So things where long agricultural histories exist will simply become unusable for agriculture. So I think agricultural price trends, things will become more difficult, but I think it doesn't suggest that things will become any cheaper. Outside agriculture, I think it's got far less of an issue. Of course, the supply chain for energy supply is an issue. The Northern Hemisphere will increasingly become an area where air conditioning becomes a need for living, for example, which will presumably put up energy consumption for the home. And similarly, there'll be parts of even the southern United States, I guess, where it's impossible to live there without air conditioning. So I think it changes depending on the commodity that you're looking at, but it's certainly unlikely to be helpful from both the point of view of delivery, but also origination of the materials. I'm slightly vague in my answer there, but that's necessarily so, I think.
Thanks, Paul. Another question here that's also got a like. Do you see the local to local trend leading to a global desync of main economies, which in turn will fuel a vicious circle of further protectionism, conflicts, wars, etc., etc.? So I think it's global to local theme.
Yeah, go back to Paul on that one, I think.
Sorry, could you say it again? I was trying to read the question on the chat and I couldn't read it.
So do you see the local to local trend leading to a global desync of main economies? So it's the global to local shift in economy, in turn fueling a vicious cycle of a circle of further protectionism, conflicts, wars, etc., etc.
Well, the current big economies just become large local economies, don't they? The protectionist vision that Donald Trump has, for example, where the United States is a mercantilist state, where it uses what it consumes and doesn't import, that would be the model necessarily after a series of trade wars, that China will become self-sufficient in petrochemicals pretty soon. You know, it's a fact, and I think that will apply with a great deal of commodities. Depending on how bad the military escalation gets in the next few years, there might be hard barriers to things. So even industrial chemicals and industrial metals, for example, might become localized commodities with their own markets. And that will have price implications for those commodities if international trade doesn't allow arbitrage of those. But that's potentially a serious matter. But yes, I think local for local will apply within regions, not just within individual countries.
Thanks, Paul. Next question, I think, is for David. So increasingly, computer data centers are building nuclear energy plants. In your opinion, is this going to disrupt the energy mix, or is this limited to computing?
I mean, I think undoubtedly we're going to see electricity demand around the world grow very fast. In fact, you know, we are out, even though renewables are growing fast, they are currently still being outpaced by electricity demand. So sadly, we are still building fossil. Data centers, I think, will be disruptive in certain locations. And I think grid capacity is as much of an issue, perhaps even more of an issue than generation capacity is. On a global demand pattern, actually data centers are not terrifically disruptive. Other things like we've mentioned, air conditioning and so on, are bigger effects. Small nuclear, I think, will have a part to play. I mean, it's a relatively unproven technology. We're seeing people make bets on it. I think it will come into place to relieve grid constraints in local areas, but it's much more expensive than solar and wind. And so I do believe that, in general, the growth in electricity supply will come from solar and wind, except where you need to debottleneck the grid by putting a powerful piece of generation right next to a piece of demand, so you don't have to beat the grid.
Thanks, David. I think we've got time for one more question. So this one is about the US housing market. So any downward pressure on US housing prices, is any downward pressure possible in the coming years? Supply continues to be constrained, especially on the starter end of the market.
Yeah, well, I think I'll pick that up, as I think you're writing a newsletter on it at some point. We may even cover it in the report. The issue is that with the central banks having the zero interest rate policies, a lot of people in the States take out 30-year mortgages, and so they took out 2 or 3% mortgages, and I think today the mortgage rate is somewhere above 7%. So if you want to move, it's pretty expensive to cancel your current 2 or 3% mortgage and move to one that's 7% plus. So you've got quite a group of people, 30 or 40% or so of the market, who just don't want to move for financial reasons. They might want to move to be closer to family, they might want to move for a job or something, but it's just too expensive. Then you also, this is another side effect of the perennials, you've got about 35 to 40% of homeowners don't have a mortgage anymore because they've paid it off. So in other words, when you raise interest rates, as the Fed did, it doesn't have the old effect that it did of cutting back consumption, because 60%, say 2/3 of the market is actually interest rate insensitive. They're either not paying for a mortgage, or they've got one which is locked in at a very low rate and it doesn't bother them. So your traditional, when the baby boomers were boomers rather than perennials, but traditional mechanism for interest rates affecting the economy has completely broken. You're pushing on a string, really. There's also, I think, a significant need, and companies like Lennar have identified this for some years now. We've been writing about it, for more multifamily occupation. So if you go back in time, most people used to live in the home. They'd move out to get married, but they'd stay close to their parents and her parents or his parents and so on. And the older people, as they got old, you would look after them in the granny flat or whatever. What actually happened with the boomers was, with the race riots and everything else, and people moved out of the cities into the suburbs, and cars were cheap, and gasoline was cheap, and so on. And so you've got a very vibrant suburban culture developing. Now, these are older people. They're not so close to hospitals. They're not so close to essential services. They might well want to move back into town or move into a more multi-person economy. And as I say, Lennar have been doing this very successfully, of carving out a separate bit of the house, so that daughter and son-in-law don't have to have granny and granddad over their shoulder all the time saying, "Oh, I don't think you should do that," or so on. They've got their own space, but you can share and you can look after them, and equally they can do babysitting for you and all those things. So you can with clever use of housing, change people's way of living for the better. But the fundamental issue of housing is that prices are just too expensive. They're at 10, 12 times earnings when they should, typically they should be at 3 or 4, maybe 5 times. So they're an enormous barrier for people, and how that gets solved without a price collapse is hard to see.
Thanks, Paul. Okay, that's absolutely perfect timing, exactly at an hour. So just to wrap up, we will send everybody an email after the webinar, probably tomorrow, with so you can have a complimentary copy of the October report, and included in that email will be a link to contact us if you'd like a free trial. So if you want a free trial, just complete the contact us form. It's very, very simple, and then we will set that up for you over the next 3 months. And that's it. So thanks to everyone for attending, and we hope you found it useful. Thanks very much.
Thank you. Thank you all very much. We're very exciting to have everybody. It's great.